Being a first-time homebuyer can be daunting, to say the least. So today I'd like to talk about what I would call the financial fundamentals for first-time homebuyers. My name is Danholm and I'm a real estate broker here in Central Florida. I serve buyers and sellers all over the state of Florida. So I do come across quite a few first-time homebuyers, and a lot of them have questions about how do I get my financials in place for buying a home? What do I need to do to be able to buy a home? How much down payment do I need? What do I do with my credit and all that? And while I'm not here to give you financial advice, I'm not licensed to do that, I am going to go over some of the basics about what you should look at to get yourself in a position as a first-time homebuyer to buy your first home. The first thing you really need to look at is your credit. Unless you have a lot of money saved up so you can buy your home cash, or you inherit a lot of money, whatever. If you have some way of paying for your home cash, you don't really need to watch the rest of this video. But if you, like most of the first-time home buyers I deal with, need to at least finance some of your home purchase, this is going to be of importance to you and really useful information for you to have on your journey to your first home. So in order to buy a home with a mortgage, you need to have relatively good credit. You don't need to have excellent credit, but you do need to have good credit. So first of all, if you don't have any credit at all, or if you have very poor credit, you need to start by building your credit. And your credits, and even if you do have decent credit, you might still want to maybe build your credit to an even better point, because the higher your credit score, the better credit you have, the lower interest you will be paying on your mortgage. So your mortgage interest rate is determined in a large part by your credit score. It's also determined by other factors, but one of the really big ones is your credit score. So how do you build your credit? Well, you start by tracking it, which means that you make sure that you follow your credit at least once a month. There are several ways you can do that. Some credit cards offer the service, so you can go and check your credit on a regular basis. You can become a member of something called Credit Karma. There are many ways you can keep track of your credit, and this is really crucial, because if there's an error on your credit, if somebody else's bad credit shows up on yours, or if somebody, even if worst case, somebody's stealing your identity, the first place you'll notice that is by following your credit score. So you really need to make sure that you check in on your credit at least once a month to see if there's anything on there that you did not know about. So you can dispute it. Say maybe there's a loan application, maybe there's something. I'm not trying to scare you here, but it is really a crucial thing to make sure that you follow your credit, you check on your credit, and make sure if there's anything on your credit that you don't know about, you dispute that. So, and the next thing is, for me, the next thing that is really important here is you need to pay your bills on time. That includes making your loan payments, your car payments, your credit card payments. Make sure you pay all of these on time, because when you go over, it will be reported to the credit bureaus, and when they get that report, they will knock your credit down. On the other hand, it also gets reported when you pay on time, which means that the more you pay on time, the higher your credit will start to grow. And a little known fact is that if you have credit cards, it is to give your credit a really good boost is if you can get those credit card balances down. I think the number is 28%. So if you have a credit limit of $1,000, if you can keep your spending on that card below $280, or at least $280 by the time when they report your credit, then that will give your credit score a really good boost, because that shows that you have way more credit available than you're using. So track your credit, make sure you pay all your bills on time, and make sure you keep those credit card balances low. It's actually not a bad thing to have a credit card or two or three. It doesn't really matter. The bad thing is if you don't pay them on time, or if you carry very high balances. And then when you get to the point where you want to buy your first house, you will need some money. there are lots of programs for down payment assistance, and sometimes you can even get all of your down payment covered by some of these programs. But you do need some money for moving. You need money for the closing costs in most cases. And even if you can manage to cut a deal with the seller and all these programs where you don't actually have to have a penny out of pocket yourself, by having savings in the bank, by managing to put aside a monthly amount and build a little savings account, even if it's not great, that will also impact the way your mortgage lender looks at you, because they will see, well, this person has managed to manage their finances in such a way that they can put money aside for a house. So even if you don't use any of this because you find a down payment assistance program, we will talk about that in another video, and maybe we get the seller to cover all your closing costs. So basically you move into this house without having a penny out of pocket. Having savings improves your chances of getting a mortgage. So once we have all this under control, once you get to this point, this is now you need to go talk to a mortgage lender and get a pre-approval letter. A pre-approval letter is a promise from the lender that they will lend you a certain amount of money on certain terms. So that could be, if you buy a house at 300,000, we will lend you 275, or if you buy a house at 300,000, we will lend you 300,000. And we will do that over 30 years at an interest rate of 5.9%. And that will cost you this X amount of dollars every month. So this is a letter that promises that the lender will give you money when you found your house. But it's a promise that is contingent, that is based on the information you gave them at the time when you got approved. So your financial situation must remain unchanged for that letter to still be valid, but I'll get back to that. So how do I get a pre-approval letter? Well, it's pretty simple, but it does involve some work on your part. You need to get in touch with a mortgage lender or mortgage broker, and then you need to fill out their loan application. And once you've done that, they will ask you for certain documents to validate, to prove what you put in the application. That could be proof that your income is as you stated it was, proof that you have a job. Anything that you stated in that application might have to be supported by some kind of documentation. And then they'll pull your credit. And the better your credit score, the better terms you get, and the higher the chance that you would even get a loan, a pre-approval letter. So once you have your pre-approval letter, you talk to someone like me, a real estate agent, and then you start looking at houses. Once you've found the house that's your dream house, the one that you really want to live in, then you submit an offer, and with that offer goes your pre-approval letter. And the pre-approval letter now serves, in the beginning, it was to show you how much money you can afford. Now it's to prove to the seller that you can actually pay for this house when you close, that there is money behind your offer, basically. So, but like I said before, the pre-approval letter is based on your financial situation on the day when you got pre-approved. This could maybe be a month or 2 months before you actually submit an offer on that house. So if your financial situation has changed in the meantime, that pre-approval might no longer be valid, and it'll say so in the letter that this is based on your current financial situation. So what you need to do, continue to do now, is to pay your bills on time, keep your credit card score low, do not take out any other loans, don't spend any big amounts of money, don't change your job. Basically, don't do anything that changes your financial situation, because if you do that, you risk that the lender will say, hey, this is not the person, at least not the financial person that we approved this loan for. This person is not what they were when we said yes to lend them this amount. So that could mean that you'll get a smaller amount, and that might not be enough for the house you found, or maybe they might not even want to lend you any money. I mean, we have seen examples of people who had a pre-approval letter, everything was good, they had good income, everything was perfect. We submit an offer with a pre-approval letter, and we get to the time when the lender needs to finalize the loan, and they say, sorry, we can't lend you any money. Why not? Well, you forgot to let us know that after you got your pre-approval, you went and bought a new car. So your monthly outgoings are now higher than they were before, so we don't think you're qualified for any loan. So really important, first of all, make sure that you get to the point where your finances are in order, and make sure they stay in order. So this is, in short, how you as any borrower, but particularly when you're a first-time home buyer, because you might not think of these things when you haven't done them before. Hopefully, if you've done it before, you've been through this, so you are aware that, well, I cannot change my situation. But this advice, if you like, goes for any home buyer that needs a mortgage. Once you get your pre-approval, make sure that your financial situation does not change. And if it does, talk to your lender immediately, and so you know if your pre-approval is still valid. So if you get a new job, talk to them, see if that changes anything. If you need to go and buy something, make sure that they still think that you have the means to buy that new house that you're looking at before you do it. Not after you've done it, but before you do it, so you don't risk being in a situation like some of our buyers sometimes have been in. You get to the point, you think you bought a house, and then the lender turns around and says, sorry, can't lend you any money, because your finances are not what they were when we said yes to you. So I really hope you found this information useful, and if you have any questions, comments, or anything, just feel free to comment below in the comment section, or send me a direct message, or give me a call. My phone number will be in the description of this video. I hope you have a great day, and I look forward to seeing you again. Until next time, my name is Danholm.